From 1921 to 1929, over 6,000 U.S. banks failed. The stock market crash in October 1929 caused another 9,000 bank failures by March 1933. In 1933, President Franklin D. Roosevelt declared, "The only thing we have to fear is fear itself." He knew banking relied on confidence. The Banking Act of 1933 introduced insured deposits. In 1934, only 9 banks failed. The Great Depression wasn't over. From 1935 to 1942, another 381 banks failed. During the 1940s, banks funded the war effort and regained strength. By 1944, 79% of bank assets were cash and U.S. government obligations. From 1943 to 1980, only 178 insured banks failed. But the 1980s brought change. Economic, financial, and regulatory factors caused a banking crisis in the savings and loan industry. More than 2,300 banks failed from 1981 to 1994. It took the Financial Institutions Reform, Recovery, and Enforcement Act of 1989 and 5 more years to restore order. The next major crisis came in 2008. Loose credit, a housing bubble, and excessive risk-taking caused the most severe financial crisis since the Great Depression. Nearly 500 banks failed between 2008 and 2013. Each crisis reveals new problems. Regulations always struggle to keep up with new challenges.